In this video, I want to highlight how to balance stocks, bonds, and other assets in your portfolio. How do you incorporate stocks, bonds, and other assets in your portfolio? So determining the right asset mix involves balancing risk and return to align with your financial goal, your time horizon, as well as your risk tolerance, or your risk appetite. So here are steps, this is a step-by-step guide. I want to see step-by-step guides on how to have a balanced portfolio. Number one is you assess your financial goals. First of all, you need to adequately and critically assess your financial goals. So in this case, you consider short-term goals, medium-term goals, as well as long-term goals. So I want to start with short-term goals. Short-term goals incorporate, a maximum of 5 years, 0 to 5 years. That's your short-term goals. So it's focusing on stability and liquidity. Favor assets like cash, money market funds, or short-term bonds. That's for short-term goals. These are the kind of assets you will use to achieve your short-term goals. Cash, money market funds, as well as some short-term bonds. Then for your medium-term goals, this will involve 5 to 10 years. So you use a mix of growth, and income generating assets such as balance and those are some. You have a balanced allocation of stocks and bonds. You have stocks and bonds in the same portfolio for your medium-term goals. Then for the long-term goals, that's 10 years and above. So in this context, you emphasize growth assets like stocks as they have higher returns. They have a higher long-term returns and return potential. So you could consider stocks for your long-term goals. Number two is understand your risk tolerance. You need to understand the level of risks you can tolerate. Each individual has his or risk tolerant level. On a scale of 1 to 10, you're going to know precisely where you fall. Number two is understand your risk tolerance. So in this case, you have high risk tolerance. If you're comfortable with volatility and can handle temporary losses, allocate more to stocks for higher growth potential. If you can stomach the risk, you should allocate more of your portfolio to stocks. Then for those who have moderate risk tolerance, risk tolerance. So in this case, there's a balance. There should be a balance with a balanced approach with a mixture of stocks and bonds, which reduces volatility while maintaining growth opportunities. Then the other one is low risk tolerance. Low risk tolerance. So if you prioritize stability over high returns, you could go in for bond, cash, and other low risk investments. So depending on your risk tolerance, you choose your strategy based on what you could stomach, as an individual. Number three is that you consider your investment time horizon. So you consider your investment time horizon in building your portfolio. So in this aspect, we look at long-term horizon and a short-term horizon. So for the long-term horizon, younger investors can take a more risk. You can take on more risk actually, with a higher allocation to stocks as they have enough time to recover from any downturn or any negative impact on their portfolio. They still have time to recover. Then for the short-term horizon, investors nearing retirement or needing funds should prioritize capital preservation through bonds or cash equivalents. In this case, capital preservation is more important than growth. And in this stage also you need regular income, regular stream of income coming in to support your lifestyle at retirement. Number four is evaluate current market conditions. Evaluate current market conditions. So in this case, we want to consider economic growth. During expansion, stocks tend to perform well. Increase, stock allocation if growth prospects are strong. You want to key into growth. You need to increase your allocation to equities. You also have a risk, a recession risk. So if the market is facing recession, if there's a recession, risk of recession, so bonds and defensive assets like gold may be better choice during may be better choices during economic slowdown. Then you also consider interest rate trends, interest rate environments. You discover that rising rates can impact bond prices negatively, but may benefit short duration bonds or other income generating assets. Bond interest kind of have an inverse relationship with interest rates. The higher the interest rate, the lower the bond yield. The lower the interest rate, the higher the bond yield. So you consider all this. Number 5 is diversify across asset classes. You diversify across asset classes. So in this case, you may consider stocks, bonds, as well as some alternative investments. So for stocks, actually, it provides growth potential, but comes with higher risk. Diversifying across industry sectors and geography may mitigate, the inherent volatility that is found associated with stock investments. You may also consider bonds. So it offers a stability and regular income. Choose a mix of government, corporate and municipal bonds based on your risk appetites. So you may also have to, take into consideration, alternative assets, and this includes real estate, commodity, or real estate investment trust for additional diversification and protection, against inflation. Not only that, we have to also look at cash and cash equivalents, cash and cash equivalents. So you maintain, some cash for liquidity and as a buffer against market downturn. You discover that, keeping cash is very, very important, particularly, when there's a market downturn. Although inflation tends to eat into cash, but at least it can serve as a buffer, So please subscribe to this channel and like this video. If you've not done that, it will help me a lot. Number 6 is use age-based guidelines. You use an age-based guideline. So there's this particular rule of thumb, and that involves subtracting your age from 100. All right, subtract your age from 100, or from 101 and 10 rather, for a more aggressive approach to determine the percentage of stocks in your portfolio. For example, if you are 30 years old, you subtract 30 from 100, that will give you 70, right? So you allocate 70%, of your portfolio to stocks and 30% to bond and cash. This is interesting, actually. It's interesting. So there's these life cycle funds, life cycle funds. Target date funds automatically adjust your asset mix as you approach your goal date, offering, a hand-off solution. That is what they do for us. That's how our pension fund administrators, that's how they manage our pension funds, our pension, fund. As you are approaching 65, your retirement age, they keep on adjusting your portfolio from one category to another. There's fund 1, fund 2, fund 3, I think fund 4 or so, till they get to retirement. So each of these classes, each of these different funds would kind of, adjust, the stock bond allocation to be able to cater for, to cater for the risks you should be exposed to at that age. Number 7 is factor in, income needs. Factor in your income needs. So in this case, there's, you may have high income needs. So you prioritize bonds, dividend, paying stocks and other income generating assets. If you have If your priority is to generate income, then you can go for bonds, dividend paying stocks, and other assets and other income yielding assets. So if you have a low income needs, you focus on growth oriented stocks or growth oriented assets like equities. If you don't really have much need for income. So number 8 is regularly rebalance your portfolio. You rebalance your portfolio regularly. In this case, you monitor changes. Market movements can shift your portfolio allocations away from the target mix. So regular rebalancing ensures you maintain the desired asset allocation. So you set a rebalancing trigger. So rebalance annually or when an asset class deviates significantly. Example, 5 to 10%, from its target percentage. If a particular asset, in your portfolio goes beyond a predetermined percentage, you could rebalance, you could sell part of it and bring it back to your expected percentage. So we have example of asset allocation model, a sample asset allocation model here. For aggressive investors, you may have 80% stocks, 15% bonds, and 5% cash or alternative investments. Then for those with a moderate risk appetite, you may have 60% stocks, 30% bonds, and 10% cash and alternatives. Then for those who are conservative, for conservative investors who cannot really stomach risk, you can go for 40% stocks, 50% bonds, and 10% cash or alternatives. So you pick you determine your risk tolerance and then allocate your you allocate your assets in your portfolio based on this particular model. I think it will go a long way in giving you the kind of returns you desire.